things, I had to adjust my saving.
The goal that you're trying to get
Yeah.
to with your, and that's for me, I think.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals.
Yeah.
So I think it's really important to be ethical and make sure you're paying them well above.
What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Good afternoon, good evening, good morning, depending on where you are. Mr. MyCool99 says, my clock must be on Melbourne time. We are always ahead of the rest. Yes, I am fashionably late, recording from home today, and I was just working on some slides, and I got through some things, and then I didn't get through some things, and then the dogs needed to be put outside, so apologies. And I've also managed to make myself a coffee. So good afternoon, Justin. I can see you there as well, mate. Good to see you again. I feel like, Justin, you're if you attend any more of these live shows, we might have to get you a season pass. But it's good to see you again. So today we're talking about core and satellite investing, and we're going to talk about a few different things within that, like different stocks. We're going to talk about ETFs. We're going to talk about generally some of the kind of myths that happen in finance and investing. DJ Bonio, good to see you. And we're also going to field some questions. I'm going to show you talk to you about how I am trying to build wealth, and the way that I think about where you can add a lot of value as an individual investor, and where experts can add value to, or where they probably don't. So let's crack on. I've got some slides here, and actually, before we get into my slides, I wanted to ask you a question. It's my casual listening at the gym. Well, Justin, I hope that this casual listening gets you pumped up. I must admit, I do listen to a few podcasts of my own when I go to the gym. Sometimes I mix that with, but a lot of the time, yeah, I'm listening to the Knowledge Project or some Tim Ferriss podcast or something like that. I was going to ask you, because I was going to cover this today, but I decided not to. Does anyone here use a net worth or net wealth tracker? So some sort of tool that enables you to calculate your assets and your liabilities. And the reason is I was going to do this as part of the core and satellite discussion today, but what I realized is that Pocket Smith, who is helping us and supporting the Rask Invest live show, Pocket Smith, is able to do this for you. So if you automatically track your investments, and say you use like ShareSite or Navexa, or say you've got like a broker like Perla or whatever, or even Rask Invest, you can add accounts to Pocket Smith, and it can automatically calculate your net worth. Now, a lot of people, and I've done this traditionally using a spreadsheet, which is completely fine. I still might do that and then share it with you guys next week. But I just wanted to ask you this question, because I feel like, that old goal setting and acronym SMART stands for something I can't remember, but one of them is tracking your goals, like SMART goals. And the ability to track your goals means you're likely to achieve them. And so I was just wondering if anyone use it. Justin, you said My Prosperity to track finances and wealth. Joanne, you said you specifically developed your own spreadsheet, which doubles as My Financial Plan. Oh, cool. That's great. And good to see you, Vigis and Megan. Good to see you in the chat. Stuart, use the InvestSmart tool. Yeah, Stuart. So that would be that, I think they call it Portfolio Tracker. Is it Portfolio Tracker, InvestSmart? Portfolio Manager, that one. Yeah. Good old spreadsheet, says ZZ. Okay. Well, I just thought that was interesting, because it's not going to be covered today in any depth, but I thought that would be something that you all would be interested. So I'll bring that up in the next few weeks. But just a special thanks to our partners. We've got Perla, Superguide, Navexa, Pocket Smith. All of these partners will probably appear on the Rask Invest live show in coming months for different reasons. Superguide obviously is one of the best resources. This is not the best resource for superannuation information, not just for people in retirement, but if you're at that critical moment. It has some wonderful guides, and it's really, really, it's not expensive. it is really good value to sign up to a Super Guide membership and go through some of their guides and that sort of stuff. Really good. Perla for long-term investing. Navexa for basically tracking your portfolio. That's where our fake news portfolio. How is the fake news portfolio going, actually? We should just have a quick, let's just check in with our fake news portfolio. What's the latest from fake news headquarters? Up 0.56%. There you go. Probably market beating considering when we started the portfolio, and it's majority in cash. There's a lesson learned. So, and Pocketsmith, of course. So Marco uses 0. Stuart, oh yeah, you get it with Eureka Report. Okay, gotcha. Keith, you Google spreadsheet. You're more like me, Keith. That's what I probably do. But although I am transitioning to, we're actually refinancing our home at the moment with NAB. It actually settles today. It actually is supposed to have settled 9 minutes ago. So if it's settled, then we'll be able to go full flight into Pocketsmith. So I've just been waiting for that to happen before I really scale up into Pocketsmith. But basically what we wanted to do when we designed Rask Live is none of these, by the way, other than Rask Invest, which is what we manage and I run, obviously, none of these partners actually pay us to appear on Rask Live. It's just I wanted to bring you a kind of like a technology stack, like a technology suite of tools that you can use and rely on, and which I use and rely on. So you can see all that there. So that's the quote for this week. It's the same as last week because I didn't update it. I forgot it. I got stuck into all the other stuff. Robin, you said you've just started with Pocketsmith, but didn't know you could add assets and super. Yeah, so one of the things you can do, Robin, is if you use one of the portfolio trackers, you can import it that way. You can also keep track of assets and liabilities and also your mortgage in there as well. So kind of like dynamically updates all of that stuff. I don't know if we can, yeah, there we go. We can zoom in on this. So you can see property, your vehicle. In this person has a Lexus 2054, whatever that is. And it's linked to a car loan, which is over here. Okay, there you go. I'm going to get out of that one. Keep sending me off. If you haven't already subscribed to Rask Invest Live, you can do that via YouTube. Just a reminder for anyone that is watching back and didn't see the clunky disclaimer at the start, it's general financial advice only on this show. It always is on the Rask podcast. That's because we don't know your needs, goals, or objectives, so don't rely on the information that you hear or see to make an investment decision. Be sure to speak to a licensed and trusted financial planner before you do that. There is a bit of confusion every week. Some people are a bit confused. Why is it called Rask Invest Live? And you also manage something called Rask Invest where you invest for people. Well, that's because we thought that would be good marketing. But what it actually means is that we have to do the disclaimer that says Rask Invest is considered a financial product and has a product disclosure statement and target market determination issued by InvestSmart, the responsible entity of Rask Invest. These documents can be accessed on the Rask Invest website. Please seek professional advice before making any investment decision with respect to Rask Invest. That is the disclaimer for this week, ladies and gentlemen. It is done. Let's move on. So today, I need to get rid of this one too. We're going to be talking about core and satellite investing. We're going to talk about individual stocks. We're going to talk about private companies. We're going to talk about some books and resources that marry with this very well. We're going to talk about traditional finance and the way finance is done in 2024 and will be done, in my opinion, by 2030. The changes that you can probably adjust to now and get ahead of everyone else. So I'm just going to throw it over to you while I take a sip of this espresso shot that I've got. Who here follows what they would consider a core and satellite approach? Just generally, like, doesn't have to be scientific, but do you generally follow a core and satellite approach to your investing in any sort of way, whether it's through a financial advisor, whether it's just how you kind of conceptually think about it, or whether you actually literally do it in practice? You sit down and practice a core and satellite approach. Let me know in the chat, and we'll come back to your answers in just a second. While you're doing that, I'll just have a look at this portfolio. So I can see that the IAF bond ETF in our fake news portfolio is up 0.34%. Home Depot is up 2.35%. Kudos to everyone who's set in the portfolio. We also got a currency free kick on that of 0.74. Wesfarmers is 0.5. This is only in a week, so what am I saying? But basically, you can see the components of the return there, which is pretty great from Navexa on the Rask Invest fake news portfolio. So here we go. Everyone's got their responses in. Hamo Sart says nope. ZZ, you say you do for your daughter, not for yourself. What's that? What's the old saying? Do as I say, not as I do, something like that. So Isha, you do. Matua, you do. Mark, yes. Zane, yes. Heath, yes, personally. Kylie, mainly core, but need satellite. Noreen, nope. And this is all good. All satellite. Just running satellites. Stuart says generally. Speaking of individual stocks, can we please look into PXA? I am using that as a case study. With the free value investor program on Rask Education. Kevin says 50% in ETFs, 45% stocks, 5% rockets. Marco in the SMSF is core, then swings trades for a satellite. Yes, Mr. Leftovers we can. So that, and you actually reminded me something. So we recently celebrated at Rask getting 30,000 students into our courses. That actually just happened on Monday. So we were super happy about that because obviously we're on a mission to 100,000 people enrolled in our free courses. But one thing that we did a couple of weeks ago was we made the original value investor program, the one that I did in I think it was 2019, but I've said 2020 here. We made this free. So I'll just put that in the show notes. If you go to the Rask Education website, the Value Investor Program, and you go to the 2020 version, that is now free. When it first came out, it was $799. It was then subsequently replaced by the one that we've created with Equity Mates. But that one's free, and it includes like all different types of valuation spreadsheets. So I don't want to talk one book too much, but I was actually going to talk about this, and you reminded me, because if you go to this section, step 5, and if we click on this, watch me be mistaken, but if we click on this, is it this part? You can actually get all of the valuation tutorials and things that we use. So you can actually get a full DCF. You can see the tutorials that explain how to use them. Now, this is the original one. So this is from a few years ago. The new one is obviously more advanced, but that costs you money. So you probably don't want to enroll in that one straight away. But there is a lot of material here that you can get for free. So go ahead and enroll in that course if you want it. It's got valuation spreadsheets in there somewhere. I can't remember where it is, but it'll all be in there for you if you want it. PEXA is the company, by the way, which is handling my property settlement, my refinance today. So it's a great case study for us to follow. It does all the property settlement exchanges in Australia. So if you buy a house, you sell a house, chances are about 90% or more of those property transactions are now settled through the PEXA digital platform. So it's a great business. Can it grow? So it's good to see that most of you are following a core and satellite approach, and I'll explain why in just a moment. But hopefully the next, say, 10 minutes, we'll get a bit nerdy, and then we'll kind of emerge from that, and then we'll start talking about what actually happens in practice. So Megan, you've said you don't follow the strategy yet, but I need to convince my partner who is fearful of investing. Well, this is probably a good way to teach them. If you send them from this part of the conversation onwards, they'd probably be interested. So Aisha, did you buy a farm? Owen, no, I did not. I simply refinanced, Aisha. So I refinanced our home loan so that I could get an equity release, and then that gives us money to do other things like investing and these types of things. So not so much about buying the farm right now. That is still on our horizon. Don't you worry about that. So a kind of satellite approach is typically this idea that you can invest in two different ways. One way, and I'll just bring up a different color. Let's say I don't like red, but we'll bring it up anyway. One way is you have this core portfolio in the middle of low cost, sensible stuff. Now, if you're the type of person that goes to a party and talks about cryptocurrency, you would probably think that this is worse than yoga, and you're going to fall asleep if you start talking about this too much. But that's the point. This type of investing for those types of people is your plan B. Now, for most of us that are sensible long-term investors, this is not plan B. This is actually plan A, because all of the academic data, all of the industry data supports that it's this part of your wealth that will do all of the heavy lifting, or not all of it, but say somewhere between 75 and 100% of your wealth will be created by this part of your portfolio, not the individual stocks that you happen to come across. Now, obviously, everyone's different and everyone has a different journey. But I say this for people who want to start investing but don't know where to start. the best place to start is the core of your portfolio, in the boring stuff. But traditionally, as we'll speak about in a minute, most people would go see a stockbroker or just log on to their ComSec platform, or in the early days, E-Trade or something like that. And they would just think that buying individual stocks is the way to go, because they would go to a website like the AFR, they would read articles like this one that's about some sort of like market updates, or they would go here and they would read a story about Nine Entertainment, and then they'd go into they'd call their stockbroker and say, they'd say, hey, can you go and buy Nine Entertainment stock because I read an article in the AFR about it. But what you don't typically see, and this is no knock on AFR, it's just the way the system has been built for 100 years, what I typically say is people go into their news on their phone, or listen to the news at night and go, oh, I'm just going to go buy that ETF. It just doesn't work that way. So the industry for a very long time has been fueled on teaching people that buying individual stocks is what's most important, and paying attention to the news is what's most important. But realistically, as we covered in, I think it was the second ever Rask Invest live show a few weeks ago, maybe in a couple of months now, we spoke about the power of ETFs. And ETFs have the ability to make it easier for you to invest in your core portfolio, because you only have to make one investment, and it's typically diversified. It's typically low cost. You get your tax report at the end of the year sent to you. It's transparent. You can go to the ETF provider's website and see every single investment that's inside it, every single stock holding, every single bond, every single bar of gold. You can see it all. It's all fully transparent. And importantly, there's less of a behavioral element to it, is that in that you don't have to go to no offense to the AFR, I keep bringing him up, love the site. You don't have to go to the AFR and be like, oh my God, I own Nine Entertainment shares. I'm worried. Or, oh no, what else is there on here? Let's go to this page. Oh, I own Silex shares. I'm worried. You don't have to worry about that sort of stuff. So if you're new to investing, instead of just buying an individual share, you just buy the whole basket. And that's what makes it really interesting. Mr. Leftovers, with satellite investments, how can investors weigh the potential for higher returns against the increased risk and the opportunity cost of not fully participating in the broader market? That's a great question. Can you remind me of that in about 10 minutes? Because I'll come back to that, and I'll use a Warren Buffett example. So let's talk about what finance has been traditionally, because this is the way to introduce what Core Satellite can do for you. So traditionally, what people would do in their finances, like I'm talking about the last 20, 50, 100 years, it was taboo to talk about money, so no one ever did it. Let's cross that one out. Like, you would never ask someone, hey, what do you earn? Like, even today, if you ask someone, hey, what do you earn? Most people are too embarrassed. Why? You're embarrassed because you might earn more and you make the other person feel bad. You might earn too little and you feel insecure. It's one of those things we're talking about. It probably actually results in more of it. Number two, investing is only for the rich. So in the past, you wouldn't be able to invest unless you had tens of thousands of dollars, which was a lot of money 10 or 20 years ago, maybe 20 years ago. It's not like that anymore. Investing used to be costly. So you would be like, young people that are investing now would probably have a heart attack if they realized that it used to be normal to pay 5% per year in fees. But the thing is, you never knew because your financial advisor didn't have to tell you. So a lot of the finance industry would come across as corrupt and come across as really like out for themselves. There's that old cliche of a financial advisor is walking through a marina in New York City and says, and this is such and such's yacht, and this is the broker from down the street's yacht, and that's the financial advisor's yacht. And then the journalist with them says, where are the client's yachts? And the idea that the finance industry absorbs all the fees and leaves nothing back for the client. So traditionally, people would buy a house, and probably that's about it. They might buy some individual stocks, but typically they wouldn't have, unless they went down to like Collins Street in Melbourne or something like that and actually spoke to a financial advisor. The next one is, in the 80s, you could get 10% interest from a bank account. So why would you go and invest in something else? Now, that was obviously not always the case, but say 7% was pretty common. Why would you invest in the stock market if you could put 7% in something like that? ETFs didn't exist. They really didn't come into existence until the early to mid 90s. Automation didn't exist. Most people spend a lot of their life looking at stock reports from brokers and that sort of stuff if they could get their hand on them, not realizing that the broker reports were conflicted, because the only reason the broker reports get written is because that broker has some sort of relationship with the company. People started to believe that you could do a stock ratio, like a price earnings ratio, and that was an investing formula that worked, when obviously it doesn't. So now let's talk about what finance is today. Finance is talking about money is actually accepted, and that's like a really good thing, because it leads people to make better decisions. It's no longer as a taboo subject. It's like, how do you teach your kids about money? How do you teach your friends about money? Like, it's actually an okay thing to talk about, because we've realized that actually talking about it will probably lead to better outcomes. You can invest as little as 1 cent. So there are platforms like Sharesies that allow you to invest 1 cent. Even platforms like Raise, Pearl or Micro, these types of platforms allow you to get started with under $5, I think. ComSec Pocket is like $50. Investing is low cost. Typically, fees are under 1% now, even for the more exotic types of investments. Financial advisors have a code of ethics. I would know because I'm studying it right now. Most people want to buy a property and will buy a property, but they'll just use more debt to do it. Nowadays, with over 2 million Aussies having invested in ETFs now, 2 million, think about that. Most people are starting to realize that you use ETFs to create wealth, but individual stocks are more for fun or for curiosity. Now, that's a generalization. Some people will make a lot more money owning individual stocks. That's fair to say. But for the broad population, ETFs will create most of it. So 0 to 5% in interest is probably what you're going to get from a term deposit over the next 20 years, because I have this view that we're not going to go back to interest rates being like 7 or 8 or even 15%. Like, we're just not going to be able to sustain that as a society. And I think people should get used to lower interest rates persisting for longer. Maybe not, 0%, and maybe not, 8%, but like just lower for longer. Pinball, I'll get to your question in just a sec, because that's covered on the next slide, I think. So just getting used to lower interest rates means that retirees, it means that investors just more of us generally just have to invest, because we're not going to get the returns, and I'll show you some of the returns historically that you traditionally got from the stock market. We're just not going to get that. Nowadays, you can automate your salary or your pension coming from super. So you can automate your salary getting divided into buckets. You can automate your pension coming from your industry super fund or your self-managed super fund. It's really easy from a bank account for an SMSF. You can automate your investing into shares and ETFs. You can automate your tax reporting. That's why Navexa exists. Remember, that's what Navexa is doing for our fake news portfolio. Even if you're a contractor, a subby, a freelancer, you can still make automated super contributions using BPay or something like that and claim a tax deduction. So that's done too. Nowadays, people realize that it's not so much about stock ratios that are going to lead to good investment decisions. What's more likely for you to create wealth is you take control of your psychology. And this is kind of the last frontier for people to realize that good investing, it has more to do with how you behave than how smart you are. That's a Morgan Housel paraphrase, but you get the idea. And so, Pinball, you've asked about active versus passive. So most people will be familiar with this great debate that active fund managers and active stock pickers do worse than index funds. Now, just a bit of 101 education. ETF, exchange traded funds like VAS or IVV or the big ETFs. ETF does not mean passive. People still think that all ETFs are index funds or passive investments. They are not. I think there are about 400 ETFs in Australia now, and I would classify probably 100 to 150 of them as not index funds. So that is a myth. That is not true. The ETF is just the wrapper. It's like the box of favorites analogy. Remember we used that a few weeks ago? You buy the box, and whatever comes inside it is basically up to you. So you might have a mixed bag, which is more like an index fund. It's got a bit of everything, a bit of AHP, a bit of CSL, whatever. But you might buy a box, and inside the box is just cherry ripes. And that would be equivalent of an index fund or a sector fund or something like that, which we can talk about. And if you have any questions, let me know. But most people would be familiar that there's a conversation, and it's pretty prolific in the FIRE, financial independence, retire early. It's pretty Vanguard has kind of perpetuated this belief that active investing is probably, it doesn't really work. A lot of big authors out of the US and here in Australia say active investing doesn't work because there is a study, and they almost always, like 9 out of 10 people that have this argument always come back to this report. It's called the Spiva report. Here we go. That's a bit of here we go. The Spiva report. And they basically say that most active fund managers, people that pick individual stocks, do worse than an index fund, therefore pick index funds. Yes, but no. The reason why most people say that index funds do better than active funds is because of fees. They say that there's this area in between. If you got every active fund manager and you put them on this chart in a normal bell curve, and then you put every index fund, the reason that they do worse is because of fees. And statistically, it does look like that. But I actually think if you talked about stock picking or active funds management and passive or index fund investing, what you actually find is more than just fees that explain this underperformance. So the reason why we use ETFs in the core of a portfolio is not just for lower fees. There are other reasons that explain it. And I just kind of boil it down to human nature. With active fund managers, the reason why I don't put a lot of them in our core portfolios at Rask Invest is because active fund managers have a lot of things going against them. And they shouldn't be compared to an individual investor. However, they do have something in common, which is that we're human creatures. We want to act. We want activity. We think we have to do something. And let me show you what this looks like. There was a study done. This is from, I can't remember what academic journal this is from, but it's from the year 2000. And the title of the academic journal, and you can read it at your own leisure sometime else, says, "Trading is hazardous to your wealth, the common stock investment performance of individual investors." Now, what these authors did is they analyzed, and I'll zoom in so we can all see it better. What they did, I'll just read it verbatim. How about that? So they say, individual investors who hold common stocks, narrator's voice, that just means normal stocks, directly pay a tremendous performance penalty for active trading. We'll bring my microphone back. Of 66,465 households with accounts at a large discount broker during 1991 to 1996, those that trade the most earn an annual return of 11.4%, while the market earns 17.9%. In other words, ladies and gentlemen, they did 6.5% worse. So the authors go on to say, overconfidence can explain high trading levels and the resulting poor performance of individual investors. Our central message is that trading is hazardous to your wealth. End quote. And they actually cited Ben Graham, who was Warren Buffett's mentor. They say the investor's chief problem and even his worst enemy is likely to be himself. End quote. So basically what they're saying is that the more you trade, the more likely you are to do worse. And there are many reasons for this. You pay extra brokerage. You end up thinking that you crystallize your tax. You do heaps of different things. And this is individual investors. Of course, this study is pretty old. And of course, it was in the lead up to what eventually became the dot-com bubble. But this is individual. This is individual investors. Up here with active versus passive, this is professional investors, right? So what we can see is a commonality. Now, the key thing is like, well, how do these two things relate? What we find, and I was trying to find the various studies, is that people who overtrade their investments typically get to a position where they're paying more in tax, paying more in fees, but they're also holding stocks for less amount of time. Now, we discovered a few weeks ago when we talked about another industry report. Now, I'm going to bring this up here. Excuse me while I just jump around for a sec. A few weeks ago, put that there, we talked about this study. Here it is here. So a few weeks ago, we talked about this study, which basically showed that the best performing stocks on the stock market could be explained by the growth of the business itself, the sales and the profits, not what actually happens in the short term, which is things like the price earnings ratio and those types of things. It's actually due to the long-term growth of a business. This is for the top 25% of stocks on the stock market. But what the authors also show, and you may remember this, so sorry if we're going over old ground, is that it's not really until after the third or the fourth or the fifth year, somewhere in there, that any of that stuff actually determines the outcome of your investment. Because it's not until after year 5 that statistically we can say it's actually due to your business performing well, not due to some other thing like the price earnings ratio or the dividend yield or the valuation. And so this is a really important thing to understand. If you don't hold stocks long enough and you think that you're a long-term investor, it probably is not because of the reasons that you think. It's not because you picked a good company. It's just because of some other reason, some random coincidence. And so that can lead people down the wrong path. Now, if we go deeper, and I asked ChatGPT to do something for me, a calculation. It's actually pretty simple, and this chart might look like it's a bit weird, but let me just explain what it actually shows you. So what I wanted to do is I once read a study that showed that an average professional investor would hold on to a stock for 7 months. Now, I know of some fund managers who call themselves professional investors, and in particular, there's one that you should know a bit of pop trivia about the Rask network. Behind the scenes at Rask, we actually don't air interviews with fund managers and professional investors if we believe that having them present on our network would be harmful to your investments. So there are times where over the years I've used my discretion. So not only do we not let certain people come on our network, but second of all, even if they do come down to our studio and record a podcast with us, there's still a pretty high likelihood that their interview will never see the light of day. And the reason is if they come and say something that we think is not grounded in reality or is self-serving or doesn't actually present the facts correctly, it could actually be harmful to our audience. We just won't air it, and we'll tell them that we're not doing this. And so one of the big reasons that we see, I think the reasons that a lot of people that pick stocks as their kind of reason for investing and their way of investing, one of the big reasons that they underperform, obviously, is they don't hold on to the stocks long enough. They try and trade them, and it's more pronounced in professional investing. Some studies show that an average individual investor holds stocks for 6 months on average. Some studies show that an individual fund manager, so that picks stocks for you, holds them for 7.2 months. Now, this is all based on like different slices of industry data, different markets. This 7.2 months comes from, I think it was a Merrill Lynch study or Morgan Stanley from the US. But what I wanted to show in this chart is if we were investing for 10 years, which is on the bottom axis here, the x-axis, if we were investing for 10 years and that fund manager or that individual investor had 40 to 50 stocks in their portfolio, which would give me I think that would give me a headache. Like I would go to bed with a headache and I'd wake up with a headache just thinking about that many stocks. But if you had 50 stocks in your portfolio and your average holding was 7.2 months, at the end of 10 years, which is up here, you would have made, I think it's 837 different investment decisions. So you would made 837 different investment decisions after 10 years. So now you're starting to see why I truly believe that it's probably easier to be simpler with your investment decisions. But let's say, for example, that you held stocks on average for 1 year. So in this case, you hold some stocks for 3 years and some stocks for 3 weeks. You know, it's the average, right? So you might think, oh, that investment decision didn't work out, so be it. So you would be here after 10 years, you've made 500 different investment decisions. That's right here. Now let's say that you have an average holding period of 2 years, which is 4 times as long as the average for individual investors. So you'd be 4 times more steady in your hands, like you're holding on to these things. Well, you're still going to make, I think it was about 170 investment decisions over the next 10 years, 170. So it's still quite a few, right? But now let's say you just invested in one ETF. You could get away with just automating every month and just dollar cost averaging. And your decisions are going to be somewhere between 0 and, let's say, I don't know, 100. But realistically, 90% of those decisions are going to be automated. So my key point is this. One of the key advantages of being a core and satellite investor is that for the core of your money, you can build a portfolio and you can just automate as much of it as possible and take away the decision fatigue, which obviously leads to poor performance, increased costs, underperforming the average. And even when it comes to individual stocks that you might buy, you can just focus on making fewer really good decisions. Your life will be better. Your life will be easier. You'll probably have more money. So if we combine these core principles in action, a lot of people don't like to hear me say this, by the way. A lot of people like to hear me put these kind of realities on paper for them because they love individual stocks and they love picking businesses. Sometimes their profession relies on them to do that, and that is okay. But the key point is this, just kind of quarantine that part of your portfolio, because you just have to acknowledge that you're going to commit a lot of time to it and the odds are stacked against you. Even if we don't like it, they're stacked against us. So just be realistic is what I'm asking. And a core and satellite approach allows us to do this. It allows us to have the best of both worlds because we can invest our core in a way that has fewer decisions, allows us to sleep easy at night, and knows that we're kind of stacking the odds in our favor. Even if we don't get the returns of the last 20 years going forward, at least we've got that good foundation. So we can use ETFs that have, less than 1% in fees. We can diversify across asset classes like some Aussie bonds, some Aussie shares, some cash, some US shares, some European shares, all in one place. We can typically find that they are lower tax because they're diversified. We can find that they've got low turnover. Now, this isn't always readily apparent, but this is the idea that the ETFs themselves aren't constantly buying and selling because they're not. It's pretty simple. The strategy is pretty much proven. We can't say for sure that it's going to work because no one can guarantee an investment return. That's why we say past performance is not indicative of future performance, but it's about as close to sensible as I could think. Mr. Leftovers, you've just quoted one of my favorite quotes of all time, which is from Charlie Munger. Try to be consistently not stupid instead of trying to be very intelligent. Yep. Now, if you build a core and satellite portfolio and you want to put individual stocks in your core, let's say you want to put Wesfarmers or you want to put Sol Pattinson or Cochlear or one of these great businesses, and you think it's a pretty stable business, it's a pretty wonderful business. Like if we've got Sol Pats, which has performed like this, showing the chart on the screen, or Wesfarmers, which has performed like this, or ResMed, which looks like this. Like, sure, these are great businesses, and I think they could go in a core portfolio. Why? They're pretty stable businesses. I think they can, and there's nothing wrong with that. But it's just about, can you sleep easy at night knowing that that's in your portfolio? If you've got a high sleep at night score, it could probably go in your core portfolio. I think if you're going to invest in ETFs, just choose ASX listed ETFs. You don't need to go overseas and buy some weird US share ETFs, or that just complicates your tax, your estate planning, everything. Just don't do it. It's just easier just to stick with Aussie listed ETFs. And I would also probably put property in the core of a portfolio. This is probably up for debate with some people, but people don't know how to kind of categorize a property investment. I would probably say it goes in the core of a portfolio. But a lot of people just need to remember that if you're building a core portfolio and you want it to be diversified, sometimes a property can look like it's 75% of your portfolio because it's such a big amount of your money. But I would just say focus on the net assets, if that makes sense. Aisha, you say, I enjoy not having to make a decision like IVV booting out American Airlines and Etsy and adding Palantir and Dell. Yeah, exactly. And I think, Aisha, that's where most people are going to go in time. 2 million people, according to BetaShares and Investment Trends, have now invested in ETFs. So now, Satellite investing. Let's talk more about this. So we know kind of what goes in the core, and I'll come back to this in a bit, but it's like stable, more proven types of broad investments, lower costs, sensible, right? Sensible. Here's a bit of a pub test. If you get a tip at a pub, it's probably not a core investment. If your brother-in-law comes to you at the next barbecue and says, "Hey, you should," ... it's probably not a core investment. But if your uncle, who's sitting on the chair and looks like he's relaxed and wealthy, and comes to you, and you approach him and say, "Hey, what should I invest in?" Chances are it's probably something sensible, and you could consider that for your core portfolio. Now, when it comes to your satellite, I think that this is where we can start to have a bit of fun, and we can have a bit of fun knowing that we've got a plan B in place. And so the way I use this, and I'm sure many people that are watching or listening to this would invest, is why not just reserve the satellites of your portfolio for the things you're really passionate about, or the things that you believe are going to lead the world forward. Some of you may remember that I quoted a guy by the name of David Gardner a few weeks ago. This is David's Twitter. Where is he? David Gardner, the founder of the Motley Fool, or co-founder of the Motley Fool. He has this wonderful tweet pinned on his Twitter or X profile. It says, "Make your portfolio reflect your best vision for our future." I think that's such a lovely thing. I would take that and I would put that against my satellite. So I would say, make the satellites of the portfolio reflect your best vision of the future. Because if the best vision of your future comes to fruition, you're going to be glad you owned those types of companies that made that happen. So I would be looking for companies with a long growth runway, founder or family run, have competitive advantages. You must understand it inside out. So just don't go invest in one of those mining companies or something weird like that. Valuation is less important than people realize, because if you're investing for the long term, what really matters is actually just finding the companies that can grow. But understanding why a company grows is important. A lot of people think that this just means find the stock that has the best dream. That's not what it's about. It's about economics. It's about finding a company that can not just grow, but capture the value as well. And that's where the competitive advantage comes in. I think one of the best things you can do for any type of investing is track what you're doing. So you can do that in the form of Navexa. Remember, with the Rask Invest fake news portfolio, we put money in the AAA ETF to begin with, and you can see that you can add notes to why you might own that investment or why we made that investment. You could also just have a Google Doc. You could have a journal, something that you can go back to for the reason that you bought an investment. I think just the act of writing something down makes it make more sense. Joan Didion, the famous author, wrote that I write to think. So I write to think. Some people might say they think to write, but they write to think. And that is a key reason that you would write down a reason. Richard Feynman, the famous physicist, had this technique that would later be called the Feynman technique. And what it was is effectively he would have this 4-step process that he would go through. Is he would write down a theory, then try and explain it to someone. He would identify holes based on what he's saying in his knowledge, and then he would go back and refer it again, and then he would keep doing that process until he got it through it all, and he didn't have the 4th step. He didn't have those gaps in his knowledge, and he could explain it to someone. And I think that's basically the idea of investing sensibly, is you do that. Now, we don't obviously have enough time to talk about everything that goes into a core and satellite approach, but I tried to put down some resources here that you could use if you wanted to continue your investing journey. Now, this book here, you might have seen popped up on my Twitter. It also, not that I go on Twitter much these days, it also is on our Instagram at Rask. This is a book that I picked up. It only came out the day before yesterday. It came out on Tuesday. And I think it is an absolutely wonderful read. So I've got it right here. How Not to Lose $1 Million. Win at Investing by Losing Less, by John Addis, the founder of Intelligent Investor. And if you go into it, I'll just show you this. If you go into it, what you'll actually find is that all of the chapters are about different companies, either Australian companies like ARB, Cochlear, or overseas companies like Meta, which is Facebook, Apple, etc. And then John puts them all into stories and lessons that you can learn. And at the end, he has this appendix, which is basically all of other lessons that couldn't really be explained by the individual stocks themselves. So if you want a book and you want to learn about picking individual companies, I would highly, highly, highly recommend this book. I'm only about halfway through it, and I got through that in about one sitting. It is a wonderful book. Now, back to everyone. Of the books that are shown on the page here, which ones have you read? Which one would be your favorite? So we've got, obviously, John's new book, How Not to Lose $1 Million. But then we've got The Ulysses Contract by Michael Kemp, which I think is a wonderful book about understanding psychology, the difference between stock picking and ETF investing. Remember, he appeared on the old Rask Invest Rask Live show, and he talked about investing is like a farm. It's like having different crops that have different yields at different times and for different seasons. And he talks about building a portfolio and doing it that way. What about the psychology of money? It's all about how you can improve your life through just understanding yourself and your relationship with money in a way. The essays of Warren Buffett will obviously help you understand how to pick individual companies if you're looking for satellite positions. I still love this book, The Guerrilla Game, Investing in High Technology, Picking Winners in High Technology, I should say. This book was really formative for me about how you can identify industries that are going through rapid transformation and how to identify winners in that. I think they provide a really useful framework for that. Now, a good example of this would be, for example, let's say the last 5 years, you could have bought FANG stocks, Facebook, Amazon, Apple, Netflix, Google, more recently Nvidia, these types of businesses. Now, you could just buy the ETF FANG from GlobalX, and it will buy all 10 stocks, and you'll just get exposure to that. But let's say, for example, you wanted to identify which ones might be particular winners in a particular industry, like advertising. What this book does is it teaches you that in the early days, it's hard to find who is the gorilla and who is the chimp in any industry. So it lays out a framework for identifying those, but it kind of concludes that if you don't know who the chimp is and you don't know who the gorilla is, start by buying them all and then decide, once the gorillas start to emerge and the chimps start to fall away, then take the money from the chimps and give it to the gorillas. And that's basically the premise of the book. But it goes through some much finer details. It's actually a really easy read, written at the time of the dot-com boom. Investing the Last Liberal Art is actually the simplified version of Charlie Munger's kind of legacy, which is a multidisciplinary approach to understanding business and economics and that sort of stuff. Really easy book to read. And it's just divided up into some really simple chapters. So if you pick up all these books, I reckon if you picked up all these books, you would be able to weave together this framework, which would ultimately boil down to core and satellite investing. I think if you came full circle, that's probably what you'd come up with. Other good books are like Trillions, The Simple Path to Wealth, these types of things. I hope that can actually help you make these own informed decisions yourself. Mark, you did say before, sorry, just got to this. Do professional investors need to close out trades to meet quarterly or half-yearly profit targets? This would prevent them from holding good companies if they had a bad quarter. So, Mark, they don't have to. One of the things that happens with active fund managers and professional investors, which is, I guess, I don't know what you call this. Let's just say it's a phrase. We call it window dressing. So window dressing is what it kind of sounds like, is where you put on a display. And basically you walk past the window and you see something in the window, and that's about it. And so active fund managers produce quarterly reports or monthly reports, but they're only required to disclose to you their portfolio, typically their top 10 holdings, at a given point in time. So if we take, say, a 3-month period, and what happens is that fund manager owns this stock, which kind of bubbles along and looks like it's going well. Then all of a sudden it crashes because some really bad news comes out. What the fund manager might be inclined to do is, at this point in time, they're like, holy heck, I've got to report to my investors in a couple of days, is they might exit their position there and then go and invest in something else, so that when it comes time to displaying their top 10 shareholdings, that company doesn't appear in there. And so everything from the window looks pretty good. Oh, okay, it was just a bad performance during the quarter, but okay, you didn't own that really dodgy stock that everyone was talking about. So that's one of the things. Another thing is if like one stock is doing really well, they're like, yeah, well, now we've got the stock in our portfolio. It's kind of the reverse of that. That's a cynical take on it. Good long-term fund managers, one of the questions you could ask them is, what is your turnover? I think this is the key. One of the key things is, what is your turnover? This basically is the inverse of holding period. So say, for example, if someone said they have a 20% turnover, that's basically them saying that 20% of the stocks in their portfolio are sold every year. Another way to think about this is if you took 20%, right, and you did 1 divided by 20%, or 0.2, that equals an average holding period of 5 years. So effectively what you're saying is, on average, we'll hold a stock for 5 years. That's basically the math. Now, that's not always the case, but typically I find that really good fund managers have holding periods of 3 to 5 years minimum. So it'll be somewhere, say, 4 or 5 years. Like a really good example of this over the past few years is a funds management business by the name of Aorus. This is a funds management business that I think takes it seriously, Stephen and the team at Aorus. And when they first started, they only had, I think it was like 10 or 12 stocks in their portfolio. And this figure is basically reflective of how long a fund manager owns a stock. And you could calculate this for yourself. Some ETFs disclose this as well, because you got to remember, every time a stock is bought or sold, even if it's inside an ETF or an active fund, you're the one paying the tax, not the fund manager. So you should know what this figure is. Okay, pardon me. So mistakes are made, but also by me. A lot of people, I find this with our investors as well, and a lot of investors, myself included, we kind of go through our investing just figuring out the same mistakes that everyone else has made. This is why I set up here at the top, if you're a core and satellite investor, you don't have to be a satellite investor. You can just be a core investor and your life will be fine. Just invest in ETFs, build a diversified portfolio, Bob's your uncle, or let someone else do that for you. But if you're going to do individual stock investing, make sure you're curious and make sure you're willing to be humbled by your investing, because at the end of the day, when you eventually fall off the horse, because everyone does, this book by John, actually, this book that I'm holding up right here by John, is actually just about losing money. And he says, win at investing by losing less. Even the best investors lose money. Warren Buffett lose money. He owned airlines going into COVID. So that's why you got to be curious. That's why you got to be a learner. You got to read. You got to want to get better. And the way you can do that is you can just have an investing checklist. A way that you pick individual investments, either for your core portfolio or for your stocks. For example, I'm coming to this now, how I invest. But if you just go to our Rask Invest website, I've said it 100 times, and you can't be bothered paying us to do it, that's fine. Just go to the website anyway, and you can go down to this tab that says asset allocation, and you can see where we're invested, like which geographies, so like 50% international shares for this particular strategy. And you can see which individual investments we own. It's that simple. You can just copy other investors as like kind of like a base. You can also just read online and figure out what kind of is generally appropriate. But the key thing is you have a reason and a process that you follow for individual investments. Now, this one here is for individual stocks. But if you're investing in ETFs, you might just say, well, I looked at like a lot of the theory and I looked at what my super fund was doing for me, and I've kind of concluded that I should have a fair bit of stocks in my portfolio, or I'm approaching retirement, so I should have some more bonds and some more cash. I'm going to do it this way. Now, obviously, if you're approaching retirement, I would highly, highly, highly recommend you reach out to a professional, get financial advice or just investment advice from a professional one-on-one, because retirement is not something that you necessarily want to leave to chance. It's worth spending the few $1,000s to get expert advice. But my point is here is that habits that is continuously reinforced will lead to better outcomes over time. You will self-correct, you will adjust over time to what does and doesn't work for your investing personality. Finally, I wanted to just reshare this chart with you, and I'm happy to answer questions here if you like. So how I invest, I used to invest almost everything that I had in individual stocks, but now I use a core portfolio. Obviously, I'd say that because I run Rask Invest, but I use a core portfolio. I still buy individual stocks, but they're not as big a proportion of my wealth. So this is individual stocks. But I obviously I'm the biggest shareholder of the Rask Group, surprise, surprise. I also have other investments in private companies, which make up a big portion of what I'm doing nowadays. Obviously I own property, but that's a different thing entirely. But over time, what I expect to happen with my personal financial situation is I expect this part, which is the ETFs, to expand. So this might grow, if I just draw over the top of this one, it might grow to something like this, right? And I think what's going to increasingly happen is I'm only going to pick individual stocks when I'm absolutely sure that I want to own this company for like 10 years. And so I still own ProMedicus shares. This is a company that I've owned for a long time. Holy dooly, it is $162 a share. I did not know that. So I've owned ProMedicus since it was like $7. Shout out to my friend Claude Walker, who bought it for, I don't know, a couple of dollars. Andrew Page, very similar. But I want to, if I'm going to buy an individual company, I want to buy companies that have this type of potential, and I want to buy them early on. I don't want to muck around by trying to find cheap stocks. I don't want to muck around with companies that I think, are really speculative. These actually have proven business models. And basically the only things that people disagree on with all these companies I'm showing you, Xero, Wise Tech, ProMedicus, even Pexa, the only thing that people ever disagree on is basically it's too expensive. They say the valuation's not right. That's basically why most people don't buy these companies. But as we saw last week when we talked about our fake news portfolio, if you find a few of these great companies, you don't need to hold them for that long for them to turn into real money spinners for you and to do well. But most of my investments are going to be in super high quality companies in the satellite. Super high, I'll just do high quality. Q even, Owen. Small companies, like small cap stocks, like smaller companies, or even private companies, which we see over here. For the rest of my portfolio, I think is going to be consumed by ETFs, which include index funds, index ETFs, but will also include sector ETFs. I'll show you one of those in just a sec. And maybe even some like rules-based ETFs. So like a good one, I don't own it, but a good one for this would be an ETF like Qual. This is one of the most popular ETFs in Australia. It just invests in 300 global shares that have a quality filter applied to them. But an ETF that I quite like, is just a general rule, is this ETF, the iShares Global Healthcare ETF. This is probably not something that I'd put in my core portfolio, but it definitely would be something that I consider for a satellite exposure because I actually think it's an excellent ETF. You can see the management fee of 0.41% is still pretty good. And this is basically just getting all of the global healthcare companies. And what you're effectively saying is, I believe that healthcare is going to become more important in the future and these companies are going to thrive. And that's basically what you're saying. And you don't have to be a stock picker to do that. You just have to have a view. And that's probably an ETF that I would consider as an ETF. It's probably not a true core ETF. It probably sits somewhere in between. But the reality is that's an ETF I would happily put in here if I wanted to. So I hope that makes sense of how we've gone deep in a lot of these things. But the thing remains that it's hard to pick individual companies, even if you think you're really good at it. Like I thought I was really good at it. And to be honest, I think that I've got a pretty good track record. But I still think that for most people, building the core first and focusing on getting the core right is far more important than figuring out which stocks or which thematic ETF or which cryptocurrency or all that sort of nonsense. That's is nowhere near as important as just finding a core portfolio and sticking with it. There's good resources here. And I'm happy to answer any questions. There was one question which I wanted to circle back to. Yeah, so this is from Mr. Leftovers from before. With satellite investments, how can investors weigh the potential for higher returns against the increased risk and opportunity cost of not fully participating in the broader market? So I wanted to come back to this because someone one year basically challenged Warren Buffett on this. And they effectively said that, hey, Warren, you have a lot of cash in your investment portfolio. If instead of just holding the cash, you just put it into the S&P 500 index fund, you would be this much richer. You would have done this much better. And of course, with hindsight, that makes sense. You know, everyone's a genius in hindsight. But the reality is he could have just put the money in the S&P 500 index fund and probably done better. And I think the thing that you've got to keep in mind is that index investing has historically been very, very good for people, but in the future, it should still be good, but it may not be as good. So that's one of the things to keep in mind. But the way I think about it is if you have a portfolio of just broadly the entire stock market, historically, the entire stock market might grow its profits. So the companies on the stock exchange typically grow profits at, say, 6 to 7% a year. Over the ultra long term, like 30, 40, 50 years, you would expect that the stock market should go up around about that rate on average. Some years it would be really bad. Maybe in some decades it would be bad. But over the ultra long term, you've kind of got that. So that any individual investments that you make, basically you have to assume that that is the hurdle. That's kind of like, I have to do better than that over the long term. And when you go through our valuation course, pay particular attention to when it comes to the valuation and how analysts do it. What they do is they talk about something called the discount rate or the expected rate of return. This is a way that they say, I'm going to say that this company is worth this much. But the way they do that is they make a forecast into the future, and then they have a discount rate that discounts the future value back to today. That discount rate has for decades been the most controversial thing in any of Wall Street industry type stuff. But if you think about it, if you know that you're probably going to get a decent single digit return from the broad stock market over the long term, that should probably be your hurdle rate. That should probably be the bit that you assume is going to adjust for that risk at a very low hurdle indeed. So Vigesh, you've said, would you consider the Hack ETF as a satellite investment? Yeah, so the Hack ETF, I would consider it as a satellite investment. And the reason is that it does kind of cut up the market in a different way, Vigesh. So this ETF is obviously focused on all cybersecurity companies. We can see them here, Infosys, Broadcom, CrowdStrike, the wonderful CrowdStrike that now people know exists thanks to it going down. You know, we know that these companies are becoming increasingly important. I would consider this, some people call this ETF a thematic ETF because the theme is cybersecurity. I actually think it's more of a sector ETF because it's not really like a theme. It's already here. It's kind of like healthcare. The thematic for healthcare is increasing population, but for cybersecurity, it's like increased spending. So maybe that's the theme, but it's more like a sector bet. I actually think it's a really respectable ETF, but I wouldn't put it in the core of my portfolio. I think it'll be quite volatile. Where is it? The fee is a little bit higher than what I would like in my core. But again, I think it's a good ETF. And this is the thing, right? Is a lot of people in times gone by would think that, you know, I have to make a decision. Am I going to pick individual thematic ETFs or index ETFs or stocks? Why not just do all of it, but just do it in moderation? Matt, you say, how do you decide when to buy into the ETFs? For a core portfolio, Matt, so I'll tell you how we do it professionally, so that probably answers your question, is if someone sends us money to invest and it goes into there and we receive their money, basically within 24 hours, we just split it amongst whatever's the most out of balance. So every month, if someone sent us a fraction of their paycheck, it would just automatically invest. And that's how we decide. And that's what a lot of the data shows is, I don't have it here, sorry, mate. But that's what a lot of the data shows is the most sensible way for long-term investing. So yeah, this is a kind of like a way to think about it. But the difference between stock investing, which requires someone to understand individual companies, and automated ETF investing is that you don't actually have to make a decision of which stock to buy every month. If you know your core portfolio is already set up, the strategy is in motion, you just keep fueling it. I'm just, when I'm saying you, I'm talking generally, not about you specifically, just for legal reasons. But that's how we see most people doing it. And if you go back to, I think it was episode 1 of Rask Invest Live or episode 2, we talked about we quoted a Charles Schwab study, which basically shows 5 different investors contributing money at different times throughout the year. The one that basically wins is the one that has perfect vision of which day is the lowest, like for the stock market. But this person that comes second is basically just the person that invests straight away as soon as they have money to invest. Now, obviously, market timing is a whole kettle of fish, and some people believe that they can do it. But with ETFs, you don't really have to worry about that because you're diversified. The key thing is you're diversified. You've got some bonds, you've got some cash, some gold, some whatever, all in the portfolio. And that's different to just trying to pick a winning stock. ZZ, probably the final question. Aisha, you said, I have Berkshire B as a satellite, but I'm still not sure about it. So Berkshire B, BRKB. I wish you said, Aisha, Berkshire A, because then I'd be like, Aisha's a real baller here. Got a $680,000 stock for one stock. What is that in Australian dollars? $1 million for one share of the Berkshire A class. But you got the Bs. That's still really good. Let's be honest. I think of Berkshire kind of like a core holding. I think even though it's not an ETF, I actually think of it because it's so diversified, and Warren Buffett and Charlie before have all kept the business like it's a really low cost, lean operation. The thinner the carpet, what is the saying? The thinner the carpet, the bigger the dividends, the thicker the dividends. The thicker the carpet, the thinner the dividends. It's the analogy that for businesses that are focused on costs, the better it would be to be with that company. Berkshire fits the bill as being, in my opinion, I would happily own it as a satellite, but I would happily own it as a core portfolio. Same with Soul Patts in Australia, same with Wesfarmers. These are diversified companies. ZZ, quick question you asked. What is that money book you have by Tony Robbins in the background? Is it good? That one over there. Money by Tony Robbins. Yeah, it's good. I probably wouldn't read it. And it's not for the reason that you think. I can't see it. It's actually another book. It's this book. So the money book's okay. It's thicker than most textbooks. If you were going to read a Tony Robbins book, I'm definitely not looking at Tony Robbins for financial advice, put it that way. But if I was going to read a Tony Robbins book, it would be this one. So this is like the condensed version to the money book. This one is, also it should make it very clear, I don't necessarily agree with their ideas of an all-weather portfolio. So I just want to make that very clear. But how many pages is this bad boy? 256 pages, whereas the money book is 688. Do yourself a favor, read the smaller book, and then if you like it, you can go read the bigger one. That's what I would say for that. And finally, final question, how would you determine asset allocation for a core portfolio? There seems to be so many different pathways and strategies people can take at times, and it's overwhelming. So that's a good question, and what a lot of the work a financial advisor does. But the basic question is, when you get a core portfolio, how much goes in what spot? So we covered this in the second Rask Invest Lemons. So go and check it, that second Rask Invest Live. But it's basically like how much defensive stuff, which is what I'm circling in red now, is cash and bonds, and how much growth stuff do you have in a portfolio? Now, this is where a good financial advisor would sit down and do a risk profile, or you can just go and observe what super funds tend to do. there used to be this old rule, and I've talked about it before, as a really like basic rule of thumb, is people used to say, I don't know if this is correct, right? They used to say whatever your age is in bonds. So if I was 27, I'm not, but if I was 27, wouldn't that be great? 20s. I would have 20% in defensive investments. That would obviously mean that if you get to 60, you would have 60% in defensive investments. Now, this is a rule of thumb. I don't actually think that having 60% in bonds and cash would be a good idea at 60. I actually think that is not a good idea. Unless your financial advisor says so, which is different, because even at we're living longer than ever before, and this is the key difference to years gone by, is a 60-year-old might be expected to live to 90 or 85. So they still got 25 years. And if they go too conservative, their money might run out before they've got a chance. The good thing at the moment is that cash is paying, nearly 5% in income, which is great. So retirees aren't eating into that too much. And even bonds are yielding, 4%, depending on the bonds. So realistically, it's actually pretty good to be a retiree at the moment, to be honest. But or anyone that owns a home, to be honest, is pretty good at the moment. So I hope that in a roundabout way answers the question. But go back and check that out. There are some free tools online. A great financial planner is definitely the one that I would be reaching out to for that type of a question. So Zizi, you say, no, I wasn't looking for Tony Robbins' book. I was just curious since you had it. Yeah, it's all right, but I would just read the smaller one if I knew. Clarice, you've said, Unshakable is one of my favorite investing books. I read Money as well. It included a lot of self-promotion. Well, it always does. And that's kind of why I caution people about Tony Robbins' books, particularly when it's finance related. I think Tony Robbins does a lot of great work. Don't get me wrong, Clarice. But my personal opinion is that there's a lot of self-promotion. And I don't think that type of behavior is as acceptable when it comes to helping people deal with their real money. Obviously this show is called Rask Invest Live, so take it from this guy. But I think that of all the books on there, I think that you would read Unshakable. There's a lot of great books there, but start with the books that I put in the slides. That would be much better. Okay, I can answer these questions really quick. Octavian, you said, how many individual ETFs have you got in your core? Once again, you can just head to our website and find this. Like if we go to the Terra portfolio, you go down to the asset allocation, or if you're a Rask Core member, you get this, obviously. You can see that there's I think it's 8 at the moment. Yeah, it's 8. So somewhere depending on the type of portfolio, I believe that you can build a great portfolio with 7 to 10 positions nowadays. Most financial advisors would have more than that because they want more diversification, and that's fine too, I think. PNB, you said, IAF bond ETF has declined so much in price over the past few years. How does that make sense? I'm going to answer this question. It seems really confusing in just a few seconds. The reason that this bond ETF has gone down is because interest rates have gone up. If interest rates go down, this bond ETF should go up. That is the answer to that one, PDB. Bonds go in the opposite directions to interest rates, government bonds, that is. Now, it's not a guarantee of future performance, but that's why people use them. Opposite direction, just remember that. That explains it. So that calls into question the disclaimer. Past performance is not a good indicator of future performance because it means that if you took the past of that ETF and you said, oh, that's not a good ETF, you might be rudely surprised. It's not a forecast, not a recommendation. Okay, so just a quick one. We're actually going to turn the Rask Invest live show, like this live show, into a podcast. So it will just be audio and obviously missing all the visuals. But if you're on the go and you want to catch up with an episode, you can go by the end of today. It's not up there yet, but at the end of the day, you will be able to find in Apple and Spotify the Rask Invest live show as a podcast. Don't forget, there are free courses online. You can invest with us. You can take advantage of all the goodies. These things all have discounts. If you go into the YouTube description, there's URLs. We don't make any money from it, other than Rask Invest, of course. If you go in there and you join Pocket Smith, Navexa, Superguide, Perla, you can actually claim a discount. So if you're going to do it, just do it anyway through that link. I hope that makes sense. That's all I've got time for today, ladies and gentlemen. Thank you so much. We'll be back next Thursday. And have a guess what? We've got Effie Zahos joining us next Thursday. She'll be sharing, we'll all be taking a financial literacy quiz with Effie, and then we'll also be hearing of 7 really creative ways that she saves money. She's the first official guest on Rask Invest Live, but we've got heaps more on the way. So if you do have any requests, we're going to look at PEXA next month for the fake news portfolio. I love that business. We'll have a look at it and see if it's actually good value, and we'll go from there. That's it for today. Thank you so much for joining me. If you like the show, don't forget to subscribe and share it with your friends. Bye for now.